What's the chance I lose money when I invest? That is one of the main questions investors ask, and that's what we're going to talk about today, including the exact percentage chance that you lose money based on whether you invest in term deposits, shares, or property. Hey friends, welcome back to the channel. I'm Ed, an economist here at Opes Partners, and through talking about investments on TV, the radio, and writing for New Zealand's national newspapers, I try and make complex investment concepts really simple so you can be informed when you invest. And we know that investments, like shares and property, they tend to go up in value and make you money over time, but what's the chance that it doesn't? Well, this is really important because back in the 1970s, there was this psychologist called Daniel Kahneman, and he came up with this idea of loss aversion, which is basically that us humans, we hate losing money, and we actually hate losing money more than we like making money. So he did this experiment where he said to people, you can either have a 50% chance of winning $1,000 or I can just give you $450. Now, statistically, the logical thing to do is to take the 50% chance of winning the $1,000. And that's because your expected winnings are higher than if you just take the certain $450. But he actually found that more people took the lower, more certain amount of money. Well, why is that? It's because us humans overemphasize risks. And Kahneman would say that we hate the idea of losing, say, $100 twice as much as the idea of making that same $100. And the bigger that number goes, the more we hate taking that risk. Now, let's take that back and apply it to investing in shares, property, and other investments. If you invest $50,000 in shares, or you look to spend $500,000, $600,000, or even $700,000 or more on an investment property, well, according to Kahneman's theory, we're really going to concentrate and emphasize the chance of losing money. And that could actually lead you to taking less risk than you logically should. So if you invest less, and if you're more conservative, then you're probably not going to make quite as much money. So let's put some numbers around this so you can look at the actual risk that you lose money when you invest. And let's start with the safest option, term deposits. That's where you give your money to the bank and they pay you a fixed interest rate. So if you give them 10 grand for a year, they might pay you a 6% interest rate. And there is almost a 0% chance that you lose money, at least before you adjust for inflation. And that's because banks are very stable. On top of that, New Zealand is about to start enforcing the Deposit Takers Act. Now, this guarantees basically any deposits less than $100,000. So even in the unlikely scenario that a bank goes bankrupt, your investment would still be safe and guaranteed. Now let's look at shares, which are higher risk, but the chance you lose money in shares depends on how you invest. So let's say you buy a share in Walmart over in the States. That is a pretty stable blue chip company. But when we analyze the data, if you own a share in Walmart for a year, you've actually still got a 30% chance that your share goes down in value over the next year, which is pretty high. Now, bear in mind, that does mean there is a 70% chance that your share goes up in value, so way better odds than just betting it all on black at the casino. But again, us humans, we emphasize the risk. So let's say you invest for the long term in Walmart. What happens to the risk of you losing money? Well, the chance of losing money goes down. Over 15 years, there is just over a 5% chance that your shares haven't gone up in value. And the reason that that chance is still pretty high is that you're only investing in a single company. So the price or value of that stock goes up and down a lot, and it's very volatile. Now, does this actually happen? Are there any shares that haven't gone up in value over 15 years or more? Well, yes. If we think about BP, British Petroleum, their stock price peaked in 2006, and over the last 18 years, their share price has actually fallen over the long term. So even if you invest in a big, well-known company, there could still be a 1 in 20 chance that that share might not go up in value over the next 15 years. And if that sounds scary, just bear in mind that's because of Kahneman's theory. And don't forget that that still means there is a 19 in 20 chance that you are making money through your investments. And if you'd like to see more of these what's the chance I lose money videos, do me a quick favor and hit the like button. That's how I know if these are the sorts of videos that you actually want to see more of. And honestly, it just really helps out the YouTube algorithm. So if you wouldn't mind, I really appreciate that. And subscribing, that really helps too. I'm trying to grow the channel to 20,000 subscribers. Now, let's say you wanted to make investing less risky. How could you do it? Well, instead of investing in a single stock like Walmart, you might invest in a stock market index like the S&P 500. And when you do that, the chance that you lose money goes down, because if Walmart shares aren't going well, maybe Tesla or Alphabet shares are going up in value, and that can start to balance each other out. Now, the risk of losing money at the start, if you invest in an index like that, is actually around the same. It's around 28% in the first year. But over 15 years, the chance of losing money halves. It goes down from just under 6% if you invest in a single stock to under 3%. So you're half as likely to lose money over the long term when you start diversifying. It goes down from a 1 in 20 chance down to a 1 in 40 chance. It's basically the old motto of don't put all your eggs in the same basket, but now we see that idea in the numbers. The more you can diversify your investments, the less risk there is that your initial investment goes down in value. And a lot of you will want to know, well, how do you actually calculate all of these probabilities and numbers? And the first thing we do is we look at how fast stock prices and house values have gone up in the past, and then we use a fancy statistical modeling technique. It's called a Monte Carlo simulation. And this effectively just calculates the chance that your investment gets a whole heap of bad years all in a row, and that the bad years outweigh the good years. Right, now let's come to property, which is what we tend to focus on in this channel. And there are two things we've got to think about when it comes to the risk of losing money in property. The first is that property prices don't tend to jump around as much as shares. They're not as volatile. And that would usually mean that there is less risk that you'd lose money through property. But on the other hand, when you invest in property, you're buying a single house or townhouse, or maybe even an apartment. And that's a bit like investing in the Walmart shares, because you're only buying a single asset rather than a whole heap of properties at once. And when we actually look at the numbers, we see that investing in a broad-based index fund, that has a lower risk than investing in a single share, and that single shares actually have slightly less risk than investing in a single property, though they are pretty similar. So when you first buy a house, there is about a 1 in 3 chance that it goes down in value in that first year. In other words, there is a 2 in 3 chance that it increases in value. But if you hold on to that property for, let's call it 5 years, there is now an 82% chance that it's gone up in value and just an 18% chance that the value has gone down. By year 15, the chance that your individual house hasn't gone up in value is still around that 6 to 7% mark. And again, you might think, come on, Ed, does that really happen? Well, yes, in Gisborne, between 2007 and 2016, an 11-year period, house prices basically didn't increase at all, and for quite some time, they actually fell. So this isn't just a theoretical analysis. These risks actually happen in real life, and it's important that you understand them. And that's why my financial advisors at Opes Partners, they spend so much time creating plans for investors and trying to find the right areas to invest in to lower that risk even further. And if you want to create a free wealth plan, like we often talk about on this channel, you can just go to opespartners.co.nz, click that big orange button and book a free meeting. But I also don't want you to take away the wrong message from this video and think, wow, investing, it's so risky, I'm not going to do it. Because on this channel, we spend a lot of time talking about how much money you could make from property, how to live off the rent from your investment properties, and how to make an extra $1 million from property. And personally, yep, I've made a lot of money through property, and in some years, I've lost money too. So you've got to look at both the returns and the risks together. And hopefully, when you look at these numbers, you see the trend. The longer you invest, the more likely it is that you do make money.